The story does not begin with panic. It begins with silence. In late 2025, while global markets appeared calm on the surface, a decision was quietly executed inside the Reserve Bank of India. There was no press conference, no emergency meeting announced to the public, no breaking news banner on financial television. Yet beneath that calm exterior, one of the most consequential financial moves of the decade was already underway. India began reducing its exposure to U.S. Treasury bonds, not marginally, not symbolically, but decisively. Over a 12-month period, India cut more than $50 billion from its U.S. Treasury holdings. That figure alone demands attention, but the timing is what transforms this from a routine portfolio adjustment into a structural warning. This liquidation occurred while U.S. Treasury yields were near multi-decade highs. In simple terms, the United States was offering close to 5% interest on its long-term debt. According to basic financial theory, this should have attracted buyers. High yield is supposed to signal opportunity. It is meant to pull capital inward, especially from conservative institutions tasked with protecting national reserves. Yet, India did the opposite. To understand why this matters, it is important to understand who was making the decision. The Reserve Bank of India is not a hedge fund. It does not chase short-term profit. Its mandate is stability, safety, and liquidity. Every move it makes is slow, calculated, and deeply risk-averse. When an institution like this sells a safe asset during a period of high returns, it is not reacting to price. It is reacting to risk. This is the first clue. The mainstream explanation was predictable. Financial media framed the move as diversification, a rebalancing, a routine adjustment in a large portfolio. These explanations sound reasonable because they are designed to sound harmless. But they avoid the central question. Why reduce exposure to the world and reserve asset at the very moment it is paying the most? In normal markets, high yield compensates for risk. When yields rise, buyers appear. This relationship has governed global finance for decades. It is the gravity that holds the bond market together. In this case, gravity failed. India sold into strength. That behavior only makes sense if the seller believes the risk of holding the asset has begun to outweigh the benefit of the interest it pays. In other words, the concern was not about earning less. It was about losing more. This is where the story moves beyond India. The United States Treasury market is not just another investment vehicle. It is the foundation of the global financial system. U.S. government debt is treated as the baseline against which all other assets are measured. It is assumed to be liquid, reliable, and immune to default. When a major reserve manager questions that assumption, the implications extend far beyond one country's balance sheet. India reduced its holdings by roughly 21% in a single year. This was the largest annual decline in its Treasury exposure in several years. Such a move requires months of planning, internal modeling, and approval at the highest levels. This was not a reaction. It was a conclusion. The conclusion appears to be that U.S. debt has entered a new phase, one where rising yields no longer signal opportunity, but stress. At the same time this was happening, the United States was running record deficits. Debt levels had crossed $38 trillion. Interest costs were rising faster than tax revenues. Each new bond issued required more borrowing just to service existing obligations. From a distance, the system still functioned. Auctions cleared, markets remained liquid. But from the perspective of a central bank tasked with protecting national wealth over decades, not quarters, the trajectory mattered more than the headlines. India was not alone in noticing this trajectory, but India acted first. This is what makes the move so important. Large institutions rarely move together at the start of a shift. The first seller absorbs the least pain. The last seller absorbs the most. India chose not to be last. By selling quietly, over time, without drawing attention, it exited a portion of the system before the pressure became visible. This is how institutional capital moves when it believes the structure itself is changing. The question, then, is not whether the sale happened. The question is what replaced it. Capital does not vanish. When value leaves one system, it must enter another. And when the reason for the exit is fear of counterparty risk, the destination becomes just as important as the departure. To understand where that $50 billion went and why, the story must widen beyond India and beyond bonds. Because at the same moment India was stepping away from U.S. debt, another global power was executing a strategy that revealed where the future of capital was heading. The warning did not come from chaos. It came from contradiction. By early 2026, the global bond market was sending a message that conflicted with every rule taught in finance classrooms. Interest rates were rising, yet demand was falling. Yields were attractive, yet buyers were disappearing. This was not a temporary imbalance. It was a structural signal. For decades, the bond market followed a simple logic. When governments needed money, they offered higher interest. Investors responded by lending. The cycle worked because it rested on trust that the borrower would remain solvent, and that the currency used for repayment would hold value. That trust was now being tested. India's decision to reduce its U.S. Treasury holdings did not occur in isolation. It occurred during a period when the United States was issuing debt at an accelerating pace. Trillions of dollars in new bonds were entering the market, not to fund growth, but to cover existing obligations. This distinction matters. Borrowing to invest expands capacity. Borrowing to survive exposes fragility. From the perspective of a reserve manager, these two forms of debt carry very different risks. The Reserve Bank of India appeared to recognize that difference. At the same time India was selling, something unusual was happening in the yield curve. Long-term yields were rising even as economic growth slowed. This combination historically signals stress, not strength. It suggests that lenders are demanding higher compensation not for inflation alone, but for uncertainty. In other words, the market was no longer confident in the long-term balance sheet. Yet most investors ignored this signal. Equity markets remained focused on short-term earnings. Media coverage framed high yields as a sign of resilience. The deeper question, why higher yields were failing to attract buyers, was largely avoided. India did not avoid it. Instead, it asked a more uncomfortable question. What happens if rising yields are no longer enough? If a government must continuously raise rates just to find buyers, the system enters a feedback loop. Higher rates increase interest expenses. Higher expenses require more borrowing. More borrowing increases supply. Excess supply pushes rates even higher. This is not theory, it is arithmetic. India's internal models would have shown that once interest payments consume too large a share of revenue, the debt ceases to be manageable. At that point, the borrower is no longer issuing bonds for growth or stability, but to delay insolvency. From a distance, the U.S. Treasury market still looked functional. Auctions cleared, payments were made, but to a long-term creditor, the trend line mattered more than the snapshot. India chose to act before the trend became obvious. This is where the story intersects with China. While India was reducing exposure to U.S. debt, China was executing a very different strategy, one that revealed how major powers were repositioning for a new monetary environment. Western media focused on China's slowing property market and rising unemployment. These data points were real, but they were incomplete. They described the surface, not the structure. Beneath that surface, China was expanding its money supply at an extraordinary rate. Its MO2 supply had grown to nearly double that of the United States. In isolation, this might suggest inflationary risk. But money supply alone does not determine outcomes. Direction matters. China was not channeling this liquidity into financial assets. It was not propping up stock prices or preserving real estate valuations. Instead, it was redirecting capital into physical capacity, manufacturing, infrastructure, energy, and raw materials. This revealed a sharp divergence in strategy. One system was using debt to sustain asset prices and service obligations. The other was using liquidity to secure resources and production. One was reinforcing a paper structure. The other was building a physical base. India observed this divergence closely. If China reduced its reliance on U.S. treasuries while India remained exposed, India's relative position would weaken, purchasing power would shift, strategic flexibility would decline. In a competitive global system, remaining stationary while others move is itself a decision. India chose not to remain stationary. The sale of treasuries was not an expression of hostility. It was an act of self-preservation. It reflected a judgment that the global financial system was entering a phase where paper claims carried rising political and monetary risk. Sanctions, asset freezes, and currency weaponization had changed the meaning of reserve assets. Holding debt issued by another government now implied dependence on that government's policies. For a nation seeking autonomy, this dependence had become unacceptable. This is why the explanation of routine diversification fails. Diversification reduces risk by spreading exposure. India's move reduced exposure to a specific form of risk, counterparty risk tied to sovereign debt. The bond market anomaly, high yields combined with declining demand, was not a technical glitch. It was a signal that trust was being repriced. And when trust is repriced, capital looks for assets that do not depend on promises. That search leads away from paper instruments and towards something else entirely. To understand where India redirected its confidence and why that choice matters more than the sale itself, the story must now turn to the asset that sits outside the debt system altogether. That is where part 3 begins. When capital loses trust in promises, it looks for something else. It does not look for higher yield. It does not look for clever instruments. It looks for certainty. This is the point where India's decision stops being about bonds and starts being about sovereignty. After reducing its exposure to U.S. treasuries, the Reserve Bank of India did not rotate that capital into other currencies. It did not move heavily into euros or yen. Those options would have kept India inside the same system, a system built on debt, confidence, and political alignment. Instead, India increased its exposure to an asset that exists outside that system entirely: gold. This choice explains everything that came before it. Gold does not offer interest. It does not grow earnings. It does not depend on economic growth or fiscal discipline. From a short-term investment perspective, it is inefficient. Yet central banks across the world continue to accumulate it. The reason is simple. Gold has no counterparty risk. A government bond is a promise. Its value depends on the issuer's ability and willingness to repay. It also depends on the currency in which repayment occurs. If either of those variables changes, the bondholder absorbs the loss. Gold carries no such dependency. It is not issued by a government. It is not backed by policy. It does not require enforcement. It simply exists. This distinction becomes critical during periods of monetary transition. When systems are stable, yield matters. When systems are questioned, ownership matters. India appeared to recognize that the global system was shifting from a yield-driven environment to a risk-driven one. By late 2025, India's gold reserves had risen to approximately 880 metric tons. This was not a symbolic accumulation. It represented years of sustained buying, logistical coordination, and storage planning. Gold is not purchased with a mouse click. It must be sourced, refined, transported, insured, and secured. Increasing reserves at this scale reflects long-term conviction, not speculation. More importantly, the timing of this accumulation coincided with the reduction in Treasury holdings. The two moves were not separate decisions. They were opposite sides of the same strategy. One asset was being exited because it depended on trust. The other was being accumulated because it did not. This shift reveals a deeper change in how reserve managers view risk. In the past, risk was defined by volatility. Assets that fluctuated in price were considered dangerous. Assets that appeared stable were considered safe. That definition no longer holds. In a world of expanding debt, frozen reserves, and political leverage, stability can be misleading. An asset can appear stable for years and still carry existential risk if its underlying structure changes. India's move suggests that it no longer defines safety by price stability alone. It defines safety by independence. Gold offers that independence. It cannot be frozen through a financial system. It cannot be diluted by a central bank decision. It cannot be defaulted on. It sits outside the liability structure of any nation. This is why the gold share of central bank reserves has been rising globally. It is not nostalgia. It is risk management. India's increase in gold holdings was not driven by inflation fear alone. Inflation is visible and gradual. Sovereign risk is opaque and sudden. When access to reserves can be restricted overnight, when payment systems can be politicized, when assets can be reclassified by external actors, reserve managers adjust their priorities. They shift from optimizing returns to ensuring access. Gold ensures access. This brings clarity to India's earlier decision. Selling treasuries during high yields was not irrational. It was defensive. The yield was no longer sufficient compensation for the embedded political and monetary risks. The return on capital mattered less than the return of capital. This mindset marks a turning point. Once reserve managers adopt it, the logic of the bond market changes. Demand becomes conditional. Yield alone is no longer persuasive. Trust becomes the limiting factor. India was not betting against the United States in a dramatic sense. It was hedging against a system that increasingly relies on continuous borrowing, monetary expansion, and geopolitical leverage. Gold offered a hedge against all three. The decision also reflects a broader shift from paper claims to physical assets. Paper instruments can be created quickly in unlimited quantity. Physical assets require time, energy, and effort to produce. This constraint is precisely what gives them value during periods of excess liquidity. India OS strategy mirrors a growing preference among emerging economies for assets governed by physical reality rather than policy discretion. This preference does not announce itself loudly. It reveals itself through data, trends, and quiet reallocations. By the time it becomes visible to the public, the repositioning is already advanced. The key insight of this phase is simple. India did not sell treasuries because it expected immediate failure. It sold them because it no longer trusted the long-term structure supporting them. And when trust erodes at the institutional level, the shift that follows is rarely reversed. To understand what this means for the broader financial system and why this transition may accelerate rather than stabilize, the final piece of the story must address what happens when multiple actors reach the same conclusion. That is where Part 4 begins. By the time a financial shift becomes visible, it is usually already too late to avoid its consequences. This is the risk now facing the global system. India's decision to reduce its exposure to U.S. treasuries and increase its allocation to gold was not an isolated adjustment. It was an early move in what appears to be a broader, slow-moving realignment, one driven not by ideology, but by mathematics and incentives. When one large reserve holder exits quietly, markets can absorb it. When several do, the structure begins to strain. This is the danger embedded in India's action. The United States Treasury market depends on continuous demand. New debt must be issued not only to fund government operations, but to refinance existing obligations. As debt levels rise, this requirement becomes more sensitive to changes in buyer behavior. For decades, foreign central banks played a critical role in this system. They recycled trade surpluses into U.S. debt, supporting both the dollar and U.S. borrowing capacity. This arrangement worked as long as confidence remained intact. What happens when that confidence weakens? If large holders reduce purchases or begin selling, the supply-demand balance shifts. To attract buyers, yields must rise. Higher yields increase interest costs. Higher costs require more borrowing. This creates a feedback loop. The system can tolerate this loop for a time, but it becomes unstable if the buyer base continues to shrink. India AS move suggests that reserve managers are no longer confident that this loop can be managed indefinitely. This is not a forecast of immediate collapse. It is a recognition of trajectory. Financial systems rarely fail suddenly without warning. They fail after long periods of stress during which the warning signs are ignored or dismissed as temporary. In this case, the warning sign is not volatility, it is behavior. High yields failing to attract buyers, rising debt issuance met with declining foreign participation, growing reliance on domestic central bank intervention. These are not signs of strength, they are signs of dependency. As foreign demand weakens, the burden of absorbing new debt increasingly falls on domestic institutions. Eventually, the central bank becomes the buyer of last resort. At that point, monetary policy shifts from managing inflation to sustaining solvency. This transition has consequences. When a central bank must continuously create money to stabilize the bond market, currency value becomes secondary to system stability. Inflation risk increases, purchasing power erodes, confidence becomes fragile. India appears to have anticipated this risk. By reallocating reserves toward gold, it positioned itself outside this feedback loop. Gold does not require a buyer of last resort. It does not need refinancing. It does not depend on market participation to retain value. This is why the shift matters beyond India. Other emerging economies face similar incentives. If they observe that early movers can reduce exposure without disruption, they may follow. Each additional exit increases pressure on the remaining participants. This is how patterns form, not through coordination, but through imitation driven by self-interest. Once a pattern is established, markets adjust rapidly. What was once considered unthinkable becomes rational. What was once dismissed as unnecessary becomes prudent. The challenge for investors and decision makers is timing. Those who move early trade, comfort for preparation. Those who move late trade preparation for reassurance. India chose preparation. This does not mean the global system will collapse tomorrow. It means the assumptions that supported it are being reassessed by those with the most at stake. For individuals and businesses, the lesson is not to copy central banks blindly, but to understand the logic behind their actions. India was not seeking profit. It was seeking resilience. It was not reacting to headlines. It was responding to structural signals. It recognized that in an environment of rising debt, politicized finance, and expanding money supply, assets tied to promises carry different risks than assets tied to physical reality. This distinction will increasingly define capital allocation decisions. Entrepreneurs and business leaders operate within this environment, whether they acknowledge it or not. Currency stability affects costs. Interest rates affect access to capital. Inflation affects margins and planning horizons. Understanding where large institutions are positioning provides insight into how the environment may evolve. India's move suggests that the era of unquestioned trust in sovereign debt is ending, not abruptly, but gradually. And gradual shifts are often the most dangerous because they are easy to ignore. The final takeaway is not alarm, but awareness. Systems change when incentives change. Capital moves when risk is redefined. And history shows that those who adapt early preserve options. India acted before the pressure became visible. That is the signal. The rest of the world will decide how long it waits before responding.